Do you remember all those banks this year that have gone under because they held various fixed assets like bonds and stuff like that that were underwater, totally underwater? Well, they were underwater to the tune of like single digit, excuse me, I should say triple digit millions, or maybe even single digit billions. I think one of them, even the final one, was it maybe even double digit billions, First Republic or Silicon Valley. Regardless, this came out on Sunday night, and of course nobody saw it because it's Sunday night going into July 4th weekend, which is the best time to find the juicy news headlines, because Friday night or holiday weekends is when these things get released. Cool. Look at this right here. New FDI data shows Bank of America faces $100 billion potential loss in the bond market of paper losses. Bank of America claims it's not an issue as they don't plan to sell. Sound familiar? That's because it is. Both Silicon Valley Bank and First Republic Bank collapsed for this reason. Okay, now how do I switch to the next? I don't know. Oh man, I'm just going to have to click each of these. Okay, so you know what? I'm just going to click them all right now, y'all. Be patient with me. I want to make sure that you can see this stuff because this is nuts. Okay. So, some background. Bank of America is bearing the cost of decisions made 3 years ago. They decided to pump the majority of $670 billion in pandemic-era deposit inflows into debt markets. This was at a time when bonds were traded at historically high prices and low yields. What they're saying there is that Bank of America took all of that free COVID money that everybody got and bought a lot of bonds. Seemed like a safe bet at the time. However, as you know, interest rates being jacked up has made those bonds go upside down last year. It says here, as interest rates rise at their fastest pace in history, these bonds are facing a $109 billion in paper loss. Both Silicon Valley and First Republic collapsed for the same reason. When depositors wanted their money, they were forced to sell these bonds at a loss. It's also worth noting that the unrealized bond market losses are an industry-wide issue. Every single bank has this problem. Wall Street Journal a few months ago said that they identified a few hundred banks across America that have this identical problem. Total unrealized losses are at a record $600 billion at U.S. banks. This is well beyond the peak of $75 billion in 2008. Comparing Bank of America to other large banks, their $100 billion in paper losses are far larger. Below is a current unrealized bond loss by bank. JPM has $37 billion in paper losses. Wells Fargo has $42. Citi and Morgan Stanley combined are at $34. Let's zoom in. Oops. Gosh, how do I... Oh, there we go. So I'm not sure if you guys can see this. There we go. So yeah, we've got all sorts of bank here. JPMorgan. Let's see if there's any we realize. First Citizen, Citibank, United, U.S. Bank. They have $10 billion. Still smaller than Citibank, smaller than JPMorgan. Bank of New York. You could probably recognize that. $6 billion. UMB Bank. That's a Kansas City bank. $500 million. First Hawaiian, Morgan Stanley. Here's Charles Schwab. They've got $14 billion, still smaller than all the other big guys, much smaller than JPMorgan. But just to illustrate, okay? Continuing. An interesting comparison between Bank of America and JPMorgan stands out. While Bank of America's CEO was nonchalant about capital allocation, JPMorgan's CEO was not. Jamie Dimon was very reluctant to move excess cash into low-yielding treasuries back in 2020 and 2021. JP Morgan and Bank of America have handled this issue differently. The performance of the two banks' equity reflects the thinking accordingly. During the last 12 months, JPM stock is up almost 30% as compared to a loss of approximately 8% for Bank of America. Keep in mind, JP Morgan, if this is all true, what they're saying here, JP Morgan has been buying up these banks that are going bankrupt for pennies on the dollar, washing all their debt off on taxpayers and keeping all of their good assets, making themselves even more powerful. So that can be that could be very much why that's happening and why JP Morgan is in a position to buy these banks. Okay, continuing. Building on this, the $100 billion in loss don't account for credit, which the bank only made $930 million of provisions in the last quarter. This amounts to a total of $14 billion of credit loss provision for the quarter. But here's where it gets interesting. These provisions seem low. As of March 31st, Bank of America held $1 trillion of loans and leases. Hence, the bank only expects to book losses on 1% of them. But that seems very low. What he's saying there is all of the credit, whether it's credit card debts or home loans or student loans or business loans, whatever, they are expecting and budgeting to only have 1.3% of people go upside down on them and go bankrupt. But that does seem very low. It says even as bankruptcies are rising, Bank of America assumes credit losses will remain minimal. Even if a borrower doesn't meet the payments, Bank of America considers a loan performing if they foresee modifying a loan terms will enable the borrower to pay. In other words, they think if the borrower will pay the future based on terms up in the air, the loan is performing. Which wouldn't you love? Wouldn't you love to have that type of logic play out when you go to the bank for a loan? Hey, look, I've got this. I need a home loan for a house that's like way out of it's a 5-bedroom mansion. It's a 10-bedroom mansion. And, as long as I get a 50% pay raise for the next 10 years, no problem. This loan will perform. That's kind of what Bank of America, that's kind of the logic they're using. Continuing, the hope here is that Bank of America will never have to realize these $100 billion in losses. But what if they do? None of the recent bank collapses is expected to face the problems that they did. A system built on a contingency so severe is dangerous. Only time will tell if industry-wide losses in bonds will come with more bank failures. However, it's clear something needs to change. As rates rise, so do these paper losses.